Effects is still deductible. The Allied van lines or Mayflower movers or whatever it is, yes. So the cost of moving your household effects to the new location, the big van lines. When Helen moved out after the divorce, we had a lot of stuff because her family had owned one of the homes they'd owned had like 10 bedrooms in it, and we selected old furniture from there. Boy, one of those big van lines came in, long distance one, and boy, her stuff filled it. I don't know how we ever got all that in our house.
So this is just moving to wherever you're going?
Now, yes, but I want to comment on this. I'm glad Tracy brought this up. That's what I'm testing. But I would like for the posting and for your own knowledge, there are some requirements with regard to mileage and time. I'm not testing those. But if you get transferred, let's say to St. Louis, for example, will you meet the requirement? So if someone could make sure, I don't remember someone posting this yet, but maybe they did, in which case I apologize. But make sure that's covered in the online discussion. And if you're involved in a situation like this, these rules would be extremely relevant to you. But I'm not testing the distance or time requirements, but those would be significant.
This isn't necessarily moving for a job.
This is a job. This is normally where
has to be moving
it's usually
for
relating to a job. But that's an interesting point. I want to move to San Diego. Let's say I move to San Diego, and because I can't get jobs out there, I'm retiring. Do I get these benefits then? Someone take a look at that. Also, what if does anyone know the form? If your employer reimburses you for part of the move, anyone know the form for that? I think it's 3903. 3903. Let's have some research in that area. Because sometimes my mind goes a little fallow and I don't recall something. So I always rely on you guys to be my researchers. And you've been doing a good job. I thought it had to be related to a job opportunity. But what if I'm retiring and moving out?
Do you have to already have the job, or are you going somewhere to look for a job?
Interesting. Now, I think in most cases the person would already have the job because they wouldn't take the risk of going out there and then not finding the job. But let's say I'm going to move to San Diego if I have to work at Burger King. No, excuse me, In-N-Out Burger, isn't that their turf? Okay, but I'm insist on going there if I have to go for the minimum wage. That to me probably should qualify because you are going to be employed out there. But if someone can, again, expand our knowledge for that, please. I can always learn from you guys as well. There's always something in tax, always something happening, or always some proposal. The home office, we've had some posts in this area. One person adjusted, they had a little misinterpretation of the old Solomon case. Now let me just comment on that case recently. That's not the law now, but we were stuck with that for about 10 years. Well, first of all, let me ask you a question. Why are we even asking about the home office? What deductions could I receive if I have a home office that I couldn't otherwise get anyway? I mean, I could deduct under current law real estate taxes, although that may be leaving soon. I could deduct mortgage interest. I get those anyway. So what would be the benefit of the home office? Somebody posted, and it says that's a red flag. You claim the home office deduction, someone's going to look at your return. What are some of the deductions I could get for the home office? Utilities, yes. It's interesting. There used to be a rule about the phones. Said you had to have a separate phone line for the home office. But that's when everybody had landlines. So I imagine that's a little bit different now when we talk about cell phones. Yes, very excellent, but the gas utility, a portion of it. We'll talk about what portion in a few minutes. Excellent answer, Amy. What else?
Repairs and stuff like that?
To that particular part of the house.
Yeah.
But let's follow up on that. Tracy has a good point. Let's say I've got a home office, a legitimate home office, and it's on the second floor, occupying a bedroom that I converted to my home office, where I handle orders. I have some shelves there where I have merchandise, and I sell it on eBay, and I do all my work, accepting the orders in that room. What if I need to have the roof repaired? Normally, a roof repair on your personal residence is a capitalized item. It's personal. I hadn't thought about this. Could I deduct a portion of the roof repair? I've never seen a case like that. But remember, I was going to say maybe I'll be aggressive, but I know somebody will look at that because I've taken the home office deduction. You're really inspirational for me. I never thought of that before, and now I'm thinking about that
I think you could do like
situation.
if you paint and stuff in that room.
Yes, that would be fine. What else? What's one of the key factors?
Supplies.
Well, any supplies or of course depreciation on equipment in there. But what about depreciation on the residence? Normally you can't depreciate your residence. Normally you cannot deduct any of your homeowner's insurance. But you might be able to deduct a portion of it. And there used to be 2 tests. There's only 1 test. Somebody has it in the posting. What's the 1 test to determine how much you can deduct? Someone posted it. Who was it? I could look it up. Square footage. It's all based on square footage now. Yeah. Okay.
So you can deduct a
Yeah. Well, you
portion
take.
of.
Yeah. For example, on my Allstate insurance, normally non-deductible. It's personal. But if 10% of my square footage of my residence is my home office, I'm going to deduct 10% of my Allstate insurance. I'm going to depreciate 10% of that portion of my house as a 39-year property under Makers. We're going to do a lot of depreciation in your city. Yes, Dave?
What if the roof repair is over the square footage of your office?
Well, just because that was the part that was leaking, I'm not sure, but I still think at most I could base it on that same square footage percentage.
I'm cool with that.
And I'm not convinced I could do it at all. It just kind of came to me while I was relaxing up here. Now, what's a disadvantage of claiming the home office deduction? Let me tell a story. Early in my marital experience, I was married for a long time, but we've been divorced, as we talked about, for some time, and Helen's been through the 3rd husband, I think, passed away, but I'm not sure. But I remember we would go to LaGrange Park. Helen knew some lady, I don't know where she got the connection, and we would go to this lady's house, and she had converted the garage into a beauty shop. So Helen would get a perm or something there. The lady would cut my hair. And then I loved going out there because she had a little Yorkshire Terrier and I could play with the dog while Helen was getting a perm. You know, perms take a little bit of time. Now, when that lady and her husband sell the house, that's like a home office, isn't it? Because that garage portion was a place of business. What's the disadvantage when you sell the property?
No one wants that, they want a garage.
Well, you probably have to convert it back to a garage, definitely. But you really have 2 salesmen, don't you? We talked last week about the $250,000, $500,000 exclusion. But that relates to the personal living portion of your house. You've also sold a portion of your house as a business, where you have depreciation recapture and so forth. That would probably be a Section 12. We'll talk about this later in the term, a Section 1250 asset. So you got to split your sale into 2 parts, the personal residence part and the business part. So another kind of disadvantage, someone's going to look at your return and you lose some of the benefit of the $250,000 or $500,000 exclusion. Now, if you sold your house in very finely joint and you sold it for a gain of more than $500,000, you're not really losing out, but you might have some of what would be capital gain converted to ordinary income. Let's follow up on something else. So that's what I wanted to say about that. The Solomon case, just in passing, and again, someone actually posted the case. I think you posted the case.
I did the incorrect.
Yeah. Well, yeah, but you posted the case for us so we can all look at it, and then you adjusted it. So that was good. So if anyone wants to read the case, you got a good summary of it. But it was an anesthesiologist, and he worked in the OR at numerous hospitals. I don't know, let's say it was 3, it might have been 4. And he also had an office in his home that I think had a separate entrance and so forth, you know, separate access where he did insurance work, and he met with patients who may have had adverse effects from the anesthesia. And he took a home office deduction. Now, under the law, in my opinion, as it always was, that home office would be allowable because he did administrative work where there was no other place to do it. Dr. Solomon did not have an office at any of the hospitals. He had to, share somebody's office if they weren't in that day. But the Supreme Court, in one of the worst decisions ever reached, said no home office deduction, because you can only have one principal place of business for that activity. And where was the most important function performed? Well, he's the one giving you the gas in the OR. Your life is in his hands. And it said the fact, using office space, to do administrative tasks is not relevant. But the law that had to be changed, and it was changed in the late 90s, and now we go back to what the law always was. You can have more than one principal place of business for an activity. So it was it's an interesting case, and I have with me things I used to read to people. I have the Chicago District Director's newsletter where he was gloating over the great victory that the IRS achieved in that case. And whenever we have unusual tax decisions, then we have to go to Congress to get the law changed. I like the old Supreme Court, they never heard tax cases. Now they're hearing too many tax cases. Now, one thing that's on the exam that I really didn't mention until the exam review on Tuesday, so we can do it more leisurely now, since we've gone through that list, then we're going to come maybe over here. What about this? Let's say I have an apartment building in Chicago with 10 apartments. I live in one of the 10 apartments, and I rent out the other 9. Question wants us to compute the net rental income. Now, I'd have to pick up all the rents, obviously, I receive from the tenants. How much of the building could I depreciate? I live in one apartment and I rent out 9. So what percentage of the building could I depreciate? 90%. If I'm paying the heating bill for the entire building, how much can I deduct? 90%. How much can I deduct if I advertise when there's vacant apartments? All of it.
100%.
All of it. Or if I said repairs and maintenance on the rental apartments only, all of it. So there'll be a problem where you're going to have to allocate some of the items and other items will be fully deductible. And that's kind of relates to the home office, because in the home office you got partially business, partially personal. Okay. Let's come over here. Oh, why don't we come over here? All right, what the heck. I did this, I don't usually write anything on the board on this, but I had a student get very upset on the other class. Deja was there, she can tell you. It's an overly energetic student. So I wrote on the board there, so I wrote on the board here. Let's look at this Schedule M-1. Schedule M-1. This is a schedule on the Form 1120 that's been around for years. This is for C Corps, regular corporations. Now, a few years ago, for larger C Corps, they replaced it with a 4-page Schedule M-3. I think in week 7 I'll have you research that. I won't have you do it just yet. I'll have you research some of those 1120 forms. But take a look here at Schedule M-1. This room is not really receptive to writing on all the boards, is it? You guys are kind of cheated over there. Either it was longer and thinner, but anyway. What we're doing on the M1 schedule is that we're going from the book income, that's the net income in your financial statements, your income statement, and we're converting that to taxable income. So line 1 is your book income. Line 10 would be your taxable income on page 1. This is corporate, strictly C Corps. On page 1 of your 1120, the Form 1120. It'd be better if I came over here. So let's see what we have. Line 1 is book income. Line 2, I'm adding back, notice it says on the form federal income tax per books. That's often called the federal income tax provision. Why are we adding it back? Federal income tax expense, as we know, is a deductible item on our income statement for the books. But federal income tax expense has never been deductible for tax purposes. So if, let's say that book income was $1 million, and in arriving at book income, we deducted $350,000 of federal income tax. That would mean that taxable income would be $1 million plus the $350,000 or $1,350,000. Look at line 4. Income subject to tax, not recorded on the books. Income subject to tax, not recorded on the books. I can only think of one example here. It's not on the exam, but it's the only example I could think of. Let's say we made an installment sale last year. For book purposes, we picked up the entire gross profit on the books in the year of the sale. But we are going to collect the proceeds from the purchaser equitably over the next 4 taxable years. So now we're in year 2. The gain has already been picked up on the books in year 1, and now in year 2, and we'll do the same thing in year 3 and year 4, we're going to have to pick up a portion of the gross profit from the sale because we elected the installment method for tax. So this goes under income subject to tax, not recorded on the books. So I put down a portion of the gross profit from the installment sale. Look at line 5. Expenses recorded on the books this year, not deducted on the return. There's a lot of examples you could use here. They show one. I put interest expense on a loan to purchase tax-exempt securities. That's a legitimate interest on the income statement. But as we pointed out earlier, that's not deductible for income tax purposes. You could have another one here. Workers' compensation awards not yet paid out to the worker. You know, these are recognized under the all-occurrence test for financial statement purposes, but you're on the cash basis for tax. Line 6 is adding lines 1, 2, I didn't put line 3 up here, 3, 4, 5, that's line 6. Line 7, income recorded this year, not included on this return. Income recorded on the books. Book income that's not taxable. I put down the one they have is tax exempt interest. That's certainly a good one. That's book income, but it's not taxable. Also, I have life insurance proceeds on the death of a, excuse me ladies, on the death of a key man. It's sexist terminology, I know. Those life insurance proceeds would be part of book income, but they're not includable in taxable income. So these 2 items on line 7 are part of book income, but they're not taxable. So we're going to subtract them. Line 8, Deductions on this return not charged against book income. And here I have the excess of makers over book depreciation. I add lines 7 and 8 together, that gives me line 9. Then I take the, basically, line 6 minus line 9, and I get taxable income. The income per the tax return. So we have a problem on the exam next week where I'm going to give you book income. I'm going to give you some possible adjustments. And your objective will be to come up with taxable income. In real life, this is kind of a pain in the rear end. I'll be honest. I remember when I was a rookie at Arthur Anderson, the senior who was supposed to handle a tax return like this was not available. So they put me on one where there must have been 150 Schedule M items. I must confess, I was new, right out of law school. And I could not get that to come out properly. When the senior kid came back, turned out he was able, I was missing one item, and he was able to find it. Later on, I hope when I was there in my 3rd and 4th year that I would have found it and not had the difficulty trying to come up with the difference between book and taxable income. So that demonstrates another aspect to you. Oh, let's take a few miscellaneous topics here too before we move into business, travel, and meals, where we're doing a lot of our work in the online discussion area. We talked last week about salaries and wages from the income point of view. Now we're talking about salaries and wages from the deductibility point of view, like you're the employer. Let me see. A situation that was in a problem in the homework that could appear on the matching part of the exam talked about a situation where a doctor normally, let's say, paid his RN. Remember, that's a person who has achieved a special recognition, passed some exams, registered nurse. And let's say he paid her $5,000 a month. $5,000 a month. And she's going to take a month's vacation. So while she's gone, let's see, this doctor who's a proprietor, so this doctor is filing Schedule C, proprietorship. He hires his college sophomore daughter to fill in for the RN. College sophomore daughter. She's going to fill in for the RN, and he's going to pay his daughter $5,000. Obviously, his daughter doesn't even have a college degree yet, certainly has not met the optimal achievements of an RN. Let's say the daughter's services at most would be worth $1,000. But he's paying her $5,000. How much can the doctor deduct on Schedule C? $1,000. Amy's right, $1,000. He can only deduct the fair value of the services that were rendered. The rest of that would be deemed to be unreasonable compensation. Now, will it be audited? Not necessarily. I'll tell a quick story. My dad was the accounting clerk at a small electrical contracting firm in Chicago that had connections with City Hall. So you know how that used to work, especially in that era. So they did a lot of the street lighting jobs and so forth, which were probably non-bid contracts. And I remember that in the 1950s, so go back before any of you were near even being thought of as a possible person. In the 1950s, the widow of the founder would come into the office on a Friday afternoon for 1 hour, and she would manually sign the payroll checks. Not just for the office staff, but primarily for checks for the electricians. she was paid $25,000 for that 1 hour a week work, and that's back in the 50s. Imagine how much that'd be worth today. Think that was unreasonable compensation? Oh, hell yes. Basically, the company then was able to deduct the $25,000. What really was she getting? She still owned stock. Wasn't she really getting a dividend? Now, at that time, earned income was taxed at a lower tax rate than dividend. So she was probably getting a lower tax rate, and still currently dividends are not deductible. And, you know, of course, I was a young kid at the time, so I wasn't thinking about taxes, but as I look back on it now, that should have been audited. And that $25,000 should have been reclassified probably into $24,000 dividend, $1,000, you know, compensation for Mrs. K. So interesting how that worked out. It's got to be reasonable compensation. What determines how reasonable compensation is? Fair market value in that particular area for the work that's being done. I used to make the class an offer. I say, all right, all of you, I'm going to take you and I'm going to move you to Manhattan, and I'm going to give you the same compensation you're getting now. And everyone says, oh my God, no way, Bill. Geez, the cost of living is going to be twice as high over there. What if I moved you to rural Alabama? Probably live like a king or a queen there, you know, because of the lower cost of living and housing. So obviously it's the factors like the fair value of the services. I would like to say, what's the work experience of the individual? What's the educational background, which is why you're here getting these advanced degrees and so forth as well. Remember we talked last week about, what did we say too? We said that if I perform services for someone and I'm paid in the form of property, what did we say was the taxable amount to be, because the deductibility is the same? You're paying someone in the form of property. What would be the taxable or deductible amount? I think there were 2 fair market value standards, if I recall. Don't be shy, it's Bill. Well, didn't we say it was the fair market value of the property received, or the fair market value of the services rendered? Whichever is more ascertainable. In theory, they should be the same if we have an arm's length transaction. So on the exam next week, I'm going to have an employee. This employee, let's say I have a sailboat, a big sailboat, $50,000 sailboat in Monroe Harbor. And he enjoys sailing more than I do. You know, the sailing season here in Chicago is very limited amount of time. It's interesting, sometimes on the weekends you'll go out to the different harbors and people don't have their boats out, but they're sitting on the boats, you know, drinking. They don't take the boat out even. They like bobbing there, over there by the dock, or whatever. So let's say this individual did $50,000 worth of service for me. I have a sailboat that's worth $50,000. Let's say it's adjusted basis because I've been depreciating it since I entertain clients, etc. Although that could raise another issue over here. Let's say the adjusted basis is only $20,000, but it's worth $50,000. He did $50,000 worth of services, and I say, you know, Tom, you love my sailboat, and I'm tired of sailing. How about if I sign over the title to the sailboat, and I'll even include the mooring in consideration of how much I owe you? And he says, oh, hell yes, Bill, you know I love the boat. And I'm going to certainly use it more than you ever did. So what's my deduction? The $50,000. So for the exam, it's the $50,000. Now there's another issue here that I'm not testing. I'm satisfying an obligation of $50,000 with an item that has an adjusted basis of a lesser amount. That could give rise to another issue, but we're only looking at the deductibility here. And the same thing again, remember we talked about like when I had you go to the Rivers Casino and make payment on my behalf and so forth. It's just the flip side of what we had from the perspective of the taxability portion deductibility is often the opposite side of that particular coin. A few minor issues. We know we can't deduct a lot of interest, but we can deduct business interest. And we can deduct business taxes, but we already said federal income tax is not deductible. And we know, like, if we pay a sales tax on a piece of equipment, you know, like for accounting purposes, that has to be capitalized as part of the cost of the equipment. If I'm paying rent on a store for my business, obviously that's deductible. Legal and accounting fees. If these are legal and accounting fees now related to a business, they're deductible. Next week, after the exam, when you guys are wiped out and I'm bored up here, we'll talk about the legal expenses that are non-business and what's deductible and what isn't, and why our clients always confused about one aspect of that. But here it has to be related to a trade or business. Now, I want to say a few things about insurance. Deja, I'm not sure, some of these topics I didn't get to in your class for reasons that you know. Okay, so let's put down insurance. Now we're talking about the deductibility part. Okay, insurance premiums paid by an employer. Insurance premiums paid by an employer on a policy where the employer is the beneficiary. Insurance premiums paid on a policy where the employer is the beneficiary of the insurance. Those premiums are not deductible. So insurance premiums on an insurance policy where the employer is the beneficiary under the policy are not deductible. Exception, sorry ladies, key man insurance. Key man insurance. Now let's stop a second and rest your hand and talk. Obviously, if I'm paying for insurance, let's say I'm Jeffrey's employer and I'm paying for insurance where his family is the beneficiary, that's obviously deductible. It's basically a form of the compensation I'm providing for him. But if I am the beneficiary under the policy, I can't deduct the insurance premiums unless we're talking about a key man. Now, example, the Cleveland Cavaliers basketball club, or whatever the ownership is of that. Do you think that that club has insurance policy on the life of LeBron and that the club is the beneficiary of the policy? I would think so. I was so rooting last night for, I become a big Atlanta Hawks fan. Why is this? Because they're the ones playing LeBron after our disgraceful exit. I'm rooting for whoever is going to finally dethrone LeBron. Well, after all, what is his nickname? The King. Yeah, one of the students last night, not my student, we were chatting in the elevator about this, because at the time, I guess the game had been tied at halftime, and he thinks the Houston Rockets are the best team. But in which case, if they win this round, then they'll go to play whoever wins Cleveland, Atlanta. Then I'll become a big Rockets fan if that's the case.
Oh, okay.
So, but I would assume if you have an athlete like that, that you would want to have insurance on their life. I mean, not just to pay for that for his spouse or something, but for the fact that without him, if LeBron were not playing, Cleveland probably wouldn't even be in the playoffs. I know they got Kyle Irving and so forth, but you know, nevertheless. So on key man insurance, you can exclude the insurance proceeds. You could, in that case, deduct the insurance premiums. Normally you cannot if you are the beneficiary under the policy. And we did all those, good.
Why would a company want to take out a policy on an employee if they weren't a key man?
I can't see much interest in doing that, although one situation that might exist, and I think this would be appropriate, let's say that, this is often typical when you have the partners, where there'll be an insurance policy on each partner, and when they die, it goes to the partnership, so they have money to pay off the partner's estate or the partner's beneficiary. So it's probably typical in that situation. Now, let's come over here to business travel. Business travel. A lot of interesting aspects here. First of all, we have personal commuting. Personal commuting. What's the first word I have there? Personal. Some people in January on the exam, when I said which of the following is a miscellaneous itemized deduction marked personal commuting, it says personal. So you go from home to work and home. I did that yesterday. I went from home. I went to the Loop Center. I had to teach the 520 class for Chris Wynham. They were good though, and I got to do the same class to my own people on Saturday. And then I went home. Non-deductible. Non-deductible. Never has been deductible, never will be. But look at number 2 here. I actually had this situation personally, travel between jobs. I used to live in Lincoln Park, in the city. Then I started working in Oak Brook, on Jory Boulevard, Chicago Bridge and Iron, CBI Industry. So I went from home and I went to Oak Brook, and during tax season I worked a flex time job at Northern Trust Bank on LaSalle Street. You go through the Wells Street entrance, there's a guard station there. And then I went, you know, then it'd be flex time. It might be 10 o'clock at night, 11, and I'd go home. What could I deduct?
From job 1 to job
From job 1 to job 2, which was great for me because that was most of my drive home. So here I got to drive from Oak Brook all the way downtown. Then I only lived, you know, about 7 miles north of downtown. So yes, they traveled between jobs. Plus, if you qualify for an educational expense deduction and you traveled, let's say, from Oak Brook to here, the Keller Graduate School, that also would qualify. Now, if you went from home, of course, it would not qualify. And there are people, let's say, for example, I didn't mention this last night because it was more rushed, but outside salesmen. Outside salesman's home is deemed to be a place of business. So they're kind of on the, what do you call it, on the meter right when they leave home. Travel away from home overnight. Somebody posted this in here and had some other questions if I recall. This is interesting to me. And by the way, some of you have posted, some people don't have a tax home. Anyone posted on that? So I've had some posts on that, but I read both classes together. Okay, Amy. Yeah, don't have a tax home. For example, there was a famous case involving a truck driver, a single guy. He used his parents' address. He paid them $1 a day when he wasn't there, and he paid them, I think, $5 a day when he was there, and he was very seldom there. So the IRS said, and the court agreed, you really don't have a tax home. No, they said your tax home is the cab of your truck. Well, there is a bunk in there. And so when you're in your truck, you're at home. Because he didn't have a reasonable amount of cost to support another residence. There was another more recent case involving a fellow who was an ice skater for Disney on Ice. And again, didn't have a separate apartment or anything. He used his parents' address. I don't think he was paying his parents anything. And again, they said you can't be away from home overnight because you basically don't have a home. Wherever you are is where, you know, it's like the whole song, wherever Papa laid his pad or something is where he lived. So it would have been reasonable to stay away from home overnight. There was another case. We have a husband and wife, they're preachers. They travel around the country in an RV, and they stop at different churches and get permission to do preaching. Where's their home? The RV. And basically they lived out of that. Now, would it have been reasonable to stay away from home overnight? That's the key factor. If so, you could deduct transportation. These become business meals, which we'll talk about next. Lodging. And this one goes back a ways. Laundry and dry cleaning. You ever look at those old films on Turner Classic Movies? People in the 30s and the 40s, maybe even the early 50s, people didn't fly a lot. They didn't do a lot of driving. What was the primary mode of transportation? Train. And how were you dressed when you were on the train? You were in a suit. Ladies in a fancy dress or some kind of a skirt and a jacket combination. Not like now. Ladies in halters and men in shorts and everything here, biker shorts or whatever it is. No. So when you got to a destination, you checked in at the hotel and you got the 1-hour valet to press your suit so you could go to your meeting. Now, the issue I have here is, and somebody raised some points too, what determines where it'd be reasonable to stay away from home overnight? For example,
If you have too much liquor.
well, I'll talk about that in a second, but not from that perspective. Let's say I had a business meeting tomorrow afternoon in St. Louis. It's at 1 o'clock. I'm going to leave home about 7. It's 5 or 6 hours. You got to watch your speed on 55. A lot of cops there. So I drive down there. I go to the meeting. The meeting ends at 5 o'clock. I don't have hotel reservations, but I was planning on staying at the Adams Mark Hotel down there. And I say, geez, it's 5 o'clock. If I leave now, I could be home by midnight or before. So I decided to drive home, do all that driving in one day. I didn't stay away from home overnight, but it would have been reasonable to have done so I could still deduct transportation if I had any meals. Obviously didn't have lodging, and I'm not going to have laundry and dry cleaning because I didn't stay down there. But what Deja's pointing out is, I gave an example on Tuesday. I had union management negotiations that were rather antagonistic, let's say in Kankakee. From my house, I could probably be to Kankakee within an hour and a half to 2 hours. We started at 9 in the morning where we had a conference room reserved at a hotel. They brought some donuts and coffee and they brought in some sandwiches. Finally, at 7 o'clock at night, we reached an agreement. And then we have to have an hour of celebratory champagne toasts. At this point, I am almost seeing double. And I am exhausted. So I decided it would be in the interest of public safety if I didn't get in my car. I could probably be home in an hour and a half at that time. I say, why don't I stay here at the hotel? They have rooms available, and then I'll be refreshed in the morning, shower, get dressed, have a nice breakfast, and I can leisurely drive, and my reflexes will be alert. Now, the IRS would argue, well, you could have been home in an hour and a half. I'm going to say, you don't want me to be on the road at that time. So again, these are situations where it's not as clear, and you'd have to argue your perspective. Temporary versus indefinite, you're probably not familiar with this one, but there's a case just about every week in this area. Usually it's construction workers. Let's say that you're a construction worker and you live here in the Naperville area, and you're assigned to a construction project in Springfield that's supposed to last 9 months. You're going to have some duplicate living expenses because for a job engagement of a year or less, the IRS recognizes that you're not going to relocate. So you could deduct your duplicate living expenses. Basically, you could deduct your rent at the Extended Suites Hotel down in Springfield. But what if it's a 18-month project? Then the IRS says, if it's greater than a year, sorry, you should have relocated. If you decide to keep your Naperville townhouse, and then you decide to save the Extended Suites Hotel down in Springfield, that's your own choice, no deduction. The standard changed a number of years ago. It used to be a year or less, and then greater than 2 years, and in between was based on other factors. But they simplified it. A year or less, temporary, deduct duplicate living expenses, greater than a year, too bad. Domestic.
You can't deduct the year's work. It's
Yes.
just all or nothing.
Yes, it's all or nothing, that's right. But the example I talked about in Tuesday, I'll mention here. What if I told you it's going to be a 9-month project? And then we have unforeseen circumstances, like we ran into some difficulties when we were excavating. So now it's going to be 14 months. I would argue on your behalf with the IRS, hey, the project manager said it was going to be 9 months. We did not know about these unanticipated difficulties until after the construction started. Therefore, I think even though it went into 14 months, you'd be okay, because it was a reasonable projection when it was made. Now, Bill's opinion on domestic versus foreign, and I want some people to do the international part especially. I think there's a much more stringent standard for international. Let's give an example. I decide I have a business meeting in San Diego for 1 full week. So I fly first class to San Diego. My hotel and rental car during that week are all deductible. I decide to take 2 more weeks for personal pleasure. Those 2 weeks, the hotel and the rental car would not be deductible because that's personal. But because the trip was domestic and there was a legitimate reason for traveling to San Diego, I believe that I could deduct the entire cost of the first class airfare. Domestic. Let's put it international. I have a business meeting in Zurich for 1 week, and then I spend 2 weeks going through the Swiss Alps. Now, we know about the hotel or rental car or whatever. Those are obviously based on the business versus personal. But it might have cost me $6,000 for a first class airfare ticket or business class. If I spend 2/3 of my time on personal and only 1/3 on business, I will not be allowed to deduct the first class airfare. Now, I used to tell clients that 75% of the trip has to be business oriented. But there are some commentators, and maybe some of you can find them when you do the online discussion, who they make that, I used to say 80%. They're saying now it only needs to be 75%, I'm sorry. I was the one who thought you need to have 80% business. They're saying you can get away with 75%. So find some of those from websites, from CPA firms. 75%'s got to be business. No more than 25% can be personal. Otherwise, you can't deduct the major cost, which is the transportation to and from. See what you can find. Cruise ships. Oh, Lord. People used to go on these cruises to the Caribbean or elsewhere. And they would attend a 1-hour-a-day investment seminar and deduct the entire cost of the cruise. IRS has tightened up. For example, and I want someone to research this. My recollection is the ship must be U.S. flag. You know, I think about all these cruise ships. Aren't they Liberian or something, or Danish or Netherlands, or whatever it is? Well, I don't think many of them are U.S. flag, except for maybe the Delta Queen up and down the Mississippi or something. So take a look at those, because there were abuses here. Then I have down automobile expenses, Form 2106. I recommend, I don't do tax returns now, but I used to do them for, obviously, or work for I worked at the Northern Trust Flex Time for like 8 years. And other things. Actual cost incurred for business miles, I would recommend that. Keep a diary or a logbook. It's like when I was in the military. If you signed out a Jeep, well, you had to have a military license, which I did. You had to log in the odometer reading when you left, and when you returned, then you had to do some preventive maintenance. Keep records. Or I'm lazy myself now, so I use the standard mileage allowance for business miles. If you take that, all you can get is that plus parking fees and tolls. The exam covers 2014, here's 2015. Business miles for the 2014, 56 cents a mile. I think it was 56 and a half the year before. Ooh! 2015, 57.5 cents. Medical or moving, 23.5%. Oh, they cut this one down this year to 23 cents. This is a separate code section. So if I'm driving for charitable purposes, it's only 14 cents a mile. That's under the charitable contribution section. So there's a little bit about business travel, but again, you have been researching for me. I want more research. You talked about spousal travel and stuff, the old Walt Disney case, which is no longer the law. So you've been doing a nice job there. Let's come over here to business meals and entertainment. First of all, suspect entertainment facilities. Now, the word suspect is Bill's term. This is not a change in the law. This has been law for years. There are certain types of entertainment facilities where they're so receptive to personal usage that many people may be declaring a disproportionately large amount of business usage, which is not justified. That's why we have these particular restrictions that exist here. For these items, and I have personal experience with one of these, for these items, it turns out that you cannot deduct the cost of maintaining the facility, but you can deduct the cost of entertaining there. One of the items I have down, I've had personal experience with, it's the hunting lodge. The hunting lodge. When we acquired a drilling company that was down in New Orleans area, that was assigned to me. And it turned out here that they used to entertain clients at that particular location. Well, they could not maintain the cost of the hunting lodge as a deductible item. But there were some deductions that were allowed for any beverages that were served there. I'm hoping that they were alcoholic beverages. It was after the shooting had already occurred. And also the cost of any entertainment that might occur. Maybe we rented some shotguns. We've had ammunition. Some other items that go into these suspect entertainment facilities, I have down there the fishing camp, the swimming pool, the tennis courts, for you wealthier people, yachts, airplanes. These would also fall under that same designation. And I was trying to find something here. I didn't have time to read it the other day, and I can't find it naturally. The hot air balloon. The hot air balloon was deemed to be one of these entertainment facilities. So I'll take a final look here, and I was going to read it, and I'll just paraphrase it to you. I can't find it naturally. It's this class, that's I'll find it. I have an individual, Jeffrey Dodd. He was a pharmaceutical representative for a big pharmaceutical house. In order to stimulate sales, he used to take customers and their families, doctors and so forth, on to ride in his hot air balloon. And he deducted the cost of traveling in the hot air balloon. The IRS disallowed the cost, claiming it was one of these entertainment facilities under a certain code section, I think it's 274. He tried to argue that a hot air balloon is not the same as a yacht or an airplane because it doesn't have seats. He also tried to argue that the nature of the activity was more like work because there was a lot of preparatory and post-flight procedures for setting up the hot air balloon. Well, the court agreed with the IRS, and they claimed, therefore they said that the cost of the balloon, the truck and trailer that were used to transport it, the fuel that was used, all of those were non-deductible because this was deemed to be one of those suspect entertainment facilities. But the court did say that you could deduct the cost of any meals or any other type of benefits that were involved in entertaining the people. But the major cost, of course, was the balloon itself. I'm sorry I couldn't find it. Tonight when I go home, I'll find it. But that's the gist of it. Now, let's come over here and stay with business meals. First of all, what is the general percentage that's deductible? What's the general percentage that is deductible for business meals and entertainment? 50%. 50%. And by the way, for the exam next week, you'll add together the cost of food, beverage, tax, the gratuity, the tip, and the valet parking. Add them all together, show the computation, and then take it times, as you told me, 50%. That would be the answer to that question, and the computation. There is an exception, however, not for the exam, but it should get in your notes. 80% deductible. Business meals and entertainment are 80% deductible for 4 categories of workers. I put them in the shell today. I will not be online tomorrow, so I put it